Is it true that more risk always equals more return? Kind of. It depends on the type of risk that you're taking on. So the only discernible way to get higher long-run returns is to accept what's called systematic risk. Greater systematic risk. This is basically an investment professional's fancy way of saying risk associated with being in the market at all, aka volatility. This is the horrifying and titillating roller coaster ride of throwing your life savings into the market, parking your ass in front of a TV that's playing 24/7 CNBC, and then taping your eyes open. Surely there is some sector or category or company size that could help us get around the risk, right? One that's sure to always perform well? No. The trouble with this, at least as a function of the wisdom of crowds, is that if there were an asset class that is identified as providing better returns in exchange for the risk that you have to take on to get them, the risk premium goes away. This is the paradox, as Ben Felix and Cameron Passmore note on their podcast Rational Reminder a few months ago, about something called factor investing that basically attempts this. It tries to use quantifiable characteristics of a firm like size or liquidity to get better returns. And they said factor investing by definition cannot be for everyone because it relies on a sort of arbitrage that would disappear if everyone did it. We will link that episode in the show notes. An easy example of this that I think kind of makes it real is the rental property market. Rental property investing became widely fashionable as of the last decade, really like anything post 2008. And in the beginning, arbitrage opportunities were everywhere. By the way, arbitrage basically just means the ability to buy something in one market and then sell it in another market for a higher price. So in this example, we're talking about acquiring real estate in a buyer's market and then selling it, quote unquote, selling it in a rental market to renters. Back then, you could generate 2% of the property's value in gross operating revenue per year after putting only 3% down. But as people caught on and it kind of became popularized as an asset class, the arbitrage opportunities were slowly snatched up. And the 2% rule quietly became the 1% rule. And recently, investors have settled on the 0.5% rule in many areas for the amount of money that you'd expect to make on any given property, and are instead banking in a lot of cases on capital appreciation to make investing in rental properties worthwhile. In 2010, you could literally throw a rock out your window and hit a property that would create immediate cash flow because everything was so cheap. Today, armed with all the tools of the pros, you still might be able to find one or two, but you're going to struggle a lot more to do so, or you're going to fight with Tim and Connie next door to do it. Functionally, I think this means we should be skeptical of anyone who claims to have the secret sauce, anyone who is too readily willing to offer up their beat the market strategy to the masses or pump any specific asset class or holding. Because if their strategy is sound and it's relying on the one thing that does tend to reliably create overperformance in the market, they probably would not want everyone doing it. Conversely, if an investment requires other people to invest in it to be successful, you don't have an investment, you have a pyramid scheme. The point is, believing that any one thing is permanently or holistically better than everything else is a dangerous gamble.